Hey everybody, it's that special time of the week you've been waiting for, and this week it's extra special because what I'm going to do is all you freebies out there, you're probably every week you're sitting there going like, oh man, I wish I could see the paid up version. I wish I could see what it's like to be one of the super cool kids that's a fully paid up member. Well, what I'm going to do is I'm having an open house this week, and you get to see the whole video. You get to see the trade recommendations that we've got on. You get to see how much money we're making. You get to see our new trade recommendations this week. This is a one-time only, and I'm hoping you're going to look at this and you're going to say, holy moly, this is really worth a Starbucks coffee every day. I got to get this thing. So hopefully you'll see it. So this week's special, fully paid up members and freebies get the same thing this week, 1 week only. This is it. I'll probably never do it again. My staff is going to kill me for doing stuff like this. But let's get right into it, because my staff will kill me if I don't tell you that you've got to read this, memorize it, tattoo it on your kid's forehead. Okay, S&P 500 exploded up. I thought we would kind of struggle up here, but no, we exploded up. Now, I will note down in the lower right-hand corner that the volume is going down, and normally what you want is volume to be a confirming factor for the price action. Well, here the volume is not confirming the price action at all, and so that suggests that this is going to be a short-lived rally. But at this point, still, you got to give credit to the bulls. So what we should expect is we should expect the price to sell off here, go back down to the 2120 breakout level, and then start to struggle higher. This is not going to be an explosive bull market. Dow Jones, basically the same story. Here's the NASDAQ, pretty much the same story here as well. One thing I want to point out, though, is look at that green line. That's the RSI, and we got the price up above the high we made at the beginning of June, but we haven't been able to get the RSI up there. So once again, it's kind of a weak bull market. So, it's been pretty explosive over the last 3 weeks, but now it's really running out of gas. Now, on the other hand, the purple line, which is the on-balance volume, it's very supportive of the price action, so I'm not looking for a bear market by any means, and you can forget the doom and gloomers who say there's going to be a crash. They will be wrong again. For another year, they will be wrong again. Why don't those guys stick to what they know? All right, seasonality. Our seasonality indicator is strong, but we're still in the middle of a seasonally neutral period. So in this kind of environment, we don't want to be aggressive. We don't want to be aggressive. We don't want to be drawing our horns in, but we need to be saying, a half-size position to a full-size position, but we definitely don't want an above normal size position. Seasonality, we've sort of gone over this quite a bit, but so I won't bother. Yield curve still capping any gains. This is one reason why it'll be a struggling bull market. But at the same time, it also tells us we're not going to have a crash. You see, every crash that we've ever had since World War II was preceded by a year by the yield curve going negative. And as you can see down in the lower right-hand corner, we're up around 128 positive right now. We're not going to get to a negative yield curve this year at all. So no crash this year. Doom and gloomers, go hide under a golden rock. All right, asset allocation has switched pretty clearly over in favor of stocks and away from bonds, and this means that tens of billions of dollars are leaving the bond market and coming over to the stock market. At the same time, our risk indicator bounced up, still kind of weak, but they are showing a little bit more appetite for risk. You'll see when we get into our sector analysis that'll confirm it, that we're all of a sudden looking at technology stocks. We're not just looking at utilities and consumer staples, the old boring things. Global shares have perked up, but still have yet to surmount the highs we made just 3 weeks ago, the day before the Brexit vote. So let's stay away from global shares. Bonds, big island reversal up there. We gapped up, then we gapped down. That leaves an island of 5 bars up there. That's bearish. Now, I've got that big red arrow showing you that there's a lot of gaps on the way up. So, I kind of think that the bonds are going to go down to 135, 136, hit that green line, and then probably start to bounce higher. So look for for bonds to be weak this week. Bond key factors, well, you can see the top one is the price of gold, and that's pointing up, which means higher yields and lower prices. The middle one, the yellow one, I'm counting as neutral. That's the CRB index, so let's call that a push. Now, the thing that had really been pushing the price of bonds, the yields of bonds down and the price up was the blue line. The blue line is the 10-year yield in Germany. And look, it had been in a major bear market, lower yields, higher prices. But look at over the last couple of days, they've both rebounded. Now, I didn't rate it because it's just 2 days old. So is it going up? Is it going down? Or should I have counted it as zero? Well, I'm going to wait one more week before making that decision, so I did not rank it. Nonetheless, net, it looks like our indicators are suggesting higher yields, lower prices. Now, I'm getting more bulled up about the dollar. I've been telling you, let's just kind of leave it alone for a while. But a couple of weeks ago, I showed you a little flag formation. We broke out of that flag formation, and we've been going sideways ever since. Right now, we have what's called an ascending triangle formation with the flat top and the rising bottom. I think we're going to break to the upside. Furthermore, once you get into the fully paid up section, you're going to see one of the key fundamental reasons that I show my fully paid up members. So hang on for that. It's very bullish for the dollar. So here's the thing. The best strategy is to buy a break of that flat top there. That's the trade you want to be putting on. Gold has dipped over the last week, but I think it's a temporary dip, and I'm remaining bullish. We're making good money on our gold stocks, Newmont, Yamana Gold. I've got a new gold recommendation coming up in the fully paid up section. Our gold indicators, though, look at that. 2 out of 3 are negative. 1 is neutral, so that's not supportive at all. These indicators have to turn around in the next week in order for me to stay bulled up on gold. So we're going to watch this very closely. Oil. We've been talking about this for a little while now. Clearly, we're in a mini downtrend. But I also think that this is probably what's called a flag formation. Look at what's in the box. The box shows that downside momentum is running out of gas. Yeah, we're kind of making lower lows, but on the price, but not, and we're making them on the momentum too, but they're just not that much. So my feeling is we're getting awfully close to a breakout to the upside in oil, and I will get long oil when we break through that downtrend line. All right, now, as I say, coming up in just a few minutes, all you freebies, I'm going to let you have an open house and let you see what it's like to be a fully paid up member. I hope that once you see that, you're going to say, oh my God, this is the cheapest thing in the world. Who cares about $47? I can make easily $47 a month on the information I'm getting. So fully paid up members, let's just slide right in here. And I think really the biggest factor that's affecting the market here is this slide right here, no Fed hike. Now we can look at what are called Fed fund futures, say that 5 times, and we can see what the market thinks the Fed funds are going to do in the future. So the blue line was just the day before the Brexit vote. So you can see they were looking for it to be 50 basis points higher in December, and then 75 basis points out at the end of November 2017, and so on and so forth. But look at the sharp shift down. Whereas before we were looking for a 25 basis point rise in December, now they're going all the way out to like April or May of 2017 before they see that. As you know, I have been the most dovish of them all. I really did not believe that the Fed would raise interest rates this year, maybe December at the earliest, but now the market's coming around to my feeling, which is nothing will happen this week. Look, Janet Yellen does not want to raise interest rates. She is looking for any reason not to do it, and that's bullish for the stock market. That's bullish for a lot of markets, but particularly the stock market. Our proprietary adrenaline indicator, which is a fantastic indicator helping us identify what the trend is, double bullish. And when this indicator is double bullish, the market rallies at an average of 36% per annum annualized. So this is a powerful indicator. Right now it's clearly bullish. Both lines are above their smoothing. It's highly unlikely that they're going to dip down this week. Sector watch. Okay, what's green? Three things are green this week, and they weren't green last week. Industrials, materials, and healthcare are in bull markets. So we had 4 in bull markets last week. This week we only have 3. But look at our yellows. Our yellows are cyclicals. They're basically sideways markets. Cyclicals, technology, financials. And look what's red. Things that have been green all year. Consumer staples and utilities, and energy is now breaking down as well. So this is a massive change in a rotation inside the market from what used to be last are now first. So we've seen things like technology, industrials, materials, healthcare go from worst to first, and energy, consumer staples, and utilities have gone from first to worst. This is a massive change here, and we've got to change our trading strategy to keep on top of this. Corporate profits are dipping, but as I say, I find that bullish because it means the Fed will not lower interest rates. Earnings growth is dipping. Once again, when earnings growth is negative, when earnings are actually contracting, that's when the Fed is easy. Look, go back to 2008, 2009. Those were the best times to be a buyer, is when quarterly earnings are going down. Now, later this year, you can see the red line suggests that we're going to start to see some strength in earnings. That's all good. We just don't want super strong earnings. Okay, now this is bearish for the market. Down at the bottom, we can see that the forward PE, which is the price earnings ratio divided by what analysts believe earnings will be a year from now, is, it's 18 and change. Well, look, the last time we were this high, the market sold off, okay? So the problem that we have here is that valuation is getting stretched on the upside. I actually wish we would get a 10% decline and build some profitability back into this market. Now, this ratio can go down only if earnings go up or prices of the stock market go down. So yeah, it'd be nice if earnings go up, but we still have another quarter or so of downward moving earnings, of earnings contracting. So this is going to cap. It's not necessarily a bear market. If we got up to 22 or 24, then I would just be a screaming bear. But at 18 and change, or 19 actually is where we are, this is not good. Any type of other shock could cause the market to sell off by 5 or 10%. Okay, I said before about the dollar. Look at this. The 3-month interbank interest rate differential. So what this is this is the difference between the U.S. short-term interest rates and interest rates in Europe, Japan, and the UK. And you can see a sharp acceleration to the upside here in 2000 in just over the last month. And what that means is that the interest rates in the United States are much higher compared to the foreign interest rates. So if you're searching the globe for yield, you're going to want to put it in the US dollar. You're going to want to put your money in the US because your yield is going to be, in the case of the US minus Europe, it's going to be almost a full % higher. Against Japan, 0.75%, and against the UK, about 0.25%. All reasons for money to flow out of those countries and into the US. Bullish for the US dollar. Now, I think one of the best places to play is going to be the US yen. I'm getting so bulled up on this. I just gave you one reason why. Another reason why is because Shinzo Abe just got reelected in Japan, and he came out and immediately said, we got to get the economy going, as if he wasn't trying before. But he specifically said we need more monetary stimulus. More monetary stimulus. Now, the head of the Bank of Japan, Kuroda, has yet to ease. But Shinzo Abe, the prime minister, just put a gun to his head and say, Kuroda, Get easing, pal. Get easing. Start dropping 2 million yen notes from the sky. You got to get inflation up to 2%, pal. And by the way, Shinzo Abe's not going to put in the sales tax increase that he said he was going to before, which is a smart move because that was killing the economy last time they did it. So look for U.S. yen to be the leader to the upside as they go on another concerted round to destroy the value of the yen. Euro U.S., I don't think this is where the action is. You got to be long. I mean, you could be long Euro yen, but I like U.S. yen better. Commodities. Oh, forget it. That was not an up-to-date chart. My mistake. Okay. This is an up-to-date chart, though. Look at up at the top. This is inventories, and this is in relationship to the 5-year average. So 0 is the 5-year average. Look at crude took an upswing, and that's why we're seeing the crude market go down. We got too much crude here in the United States. Distillates, that's heating oil, have come down sharply, so that's supportive of that. Gasoline bouncing around about the same place. Now in the bottom panel, you can see that because because distillates have come down, gasoline's come down, the refining capacity is just, it's getting towards the 5-year average, whereas we were running very, very high. All right, let's get into our trades. Wow, we're crushing it over here. We got in, we're already up 20%. We've only been in the trade for like 2 weeks. I love it. I'm going to shoot myself. This is a trade that I watched. I told you to watch, and of course it's taken off, and I don't own it. But we'll find a way to get involved in this stock because the underlying fundamentals are awesome. Okay, the AUY calls, we're making a little bit of money here. We kind of stabilized over the last week, but I find that to be bullish because gold was going down in price. AUY, the amount of gold, went sideways. So if the price of gold starts to go up, this is going to skyrocket. New trade here, Broadsoft. We're going to buy it here at the market. Just broke out of this formation. Put a stop way down at the lows we made about 3 weeks ago. Once again, super strong fundamentals here. This is one we've been in a long time. I'm not happy here. We're not stopped out, but boy, look at that. This is one where I bought at the absolute wrong time. Anyway, we're still suffering, but the market is starting to turn higher. I'll hang on to it a little bit longer. Our CRM NOV 90 call, good idea. We bought it well, but as you can see, the market's gone nowhere for 6 months, so our time decay is slowly hurting us. On the other hand, DICOM skyrocketing. We're making real good money on this one, and the coast is all clear for us to continue to make money. Once again, great fundamentals, great technicals. All right, we finally got out of this one. Yeah, exit. Losing trade, but we'll get out with some of our money. A new trade here is we'll buy a break to new highs, INXN, Interzion Holding. Head and Shoulders bottom. Great fundamentals, accelerating earnings, which of course I love. And if that's the right shoulder of a Head and Shoulders, then this will be a killer trade. So we're going to buy on a 38.70 stop with a protective stop at 36.09. KBH, one of our 2 housing stocks. Wow. We are crushing it here. Thing is up. We've been in it just a little while, and already, look, this chart is fantastic. We're going to the moon on this thing. We've already gone to the moon here in LGI Homes. I'm raising my stop up to lock in a profit now, but I think we're not going to get stopped out here for a long time. These 2 housing stocks are doing great. Nobody's talking about housing stocks, but here we are. We're making good money here. Ligand, we just got into it. Really nothing much has happened yet. Mobileye, awesome. We got this call. Really breaking even on the trade. I think this thing's going to be a huge winner. Very few companies show accelerating earnings in this environment, and this is one of those companies, Mobileye. NEE, this is our utility stock that has made us a lot of money, as you can see on this chart. And we've been in and out of it. We already took a big profit the first time we were in it. We now have a double-sized position, and as you saw the sector watch, utilities are not in great shape here. Now, we're doing fine on this trade, so I'm going to give it one more week, and if it doesn't perk up, I'll take our profits next week. NUE, I just want to shoot myself. I told you I thought this would be a good one. I told you I was going to wait until I saw a good low-risk entry point. I never saw that low-risk entry point, and man, this thing just took off. Play, Dave & Buster's, grinding higher. Would be nice if we're making good money, but it would be nice if it was exploding higher, but we'll take it. Another one of those stocks that I haven't been able to get into, PZZA, Papa John's. But now that we've got a little dip in the market, maybe next week I can start to put in some entry orders here. WB, wow, exploded higher. Got a nice profit on this. Chinese stocks in general are doing really well. I've got a couple more that I'm researching right now, and hopefully we'll give you a couple more Chinese companies that we're going to want to get into next week. Yeah. All right. Fully paid up members. Freebies, don't forget. I hope you enjoyed seeing how much money we were making. And I think you can easily see that you can make the $47 a month that it costs to subscribe. So just go to that website up at the top of the page, bit.ly/weekly market forecast. And yes, you got to have the capital W, capital M, capital F. Right now, let me wrap this up. So freebies, please go subscribe right now. You don't need to listen to me finish talking. But fully paid up members, no, I'm just joking. Everybody should listen. Here's the thing. Right now, the market exploded higher. We broke to new highs. That's bullish. In the final analysis, all the indicators in the world are meaningless. Price is the most important thing. We're not seeing a massive bull market. We're seeing a sluggish bull market, and that's what we're going to see for the rest of the year. We're going to slowly grind higher. Yes, we'll probably have a 4 or 5% correction in the late summer, early fall, let's say September for argument's sake. But the reality is that we're going to grind higher because monetary policy is so loose. Yes, we will see some shaky action in September because of uncertainty over who's going to be the president. One thing we do know for certain is that no matter who is elected, whether Hillary or the Donald, both of them are anti-free trade, and that's going to disturb the market as well. So look for a little bit of a dip during that time period, but I doubt if it'll even be a 10% dip, maybe a 3 to 5% dip in the market, something like that. The reason why it'll be so mild is because in the final analysis, the president doesn't have infinite power. They still have to get stuff through Congress, and Congress still has to approve the spending. So even if the president waves his magic wand and says, I want this to happen, Congress has to vote to approve the money. So our Republican form of government will mean that the presidential election is important, but not as important as it is in other countries, and not as important as the market or as the populace will give to it. So look for the market to be a little bit of shaken. Let's call it September, August through October, sometime in that period. Maybe, like I say, 5% correction. And then we'll get back to a normal bullish seasonal, probably coming in a little bit late this year, around November, something like that. And then next year should be really a good year, a super year. The other thing I want to say about this market is that fortunately, as you can see, our stocks are doing better than the stock market. Why? Because we're in a market of stocks, not a stock market. There's a lot of sectors going up, a lot of sectors going down, and that's a perfect environment for us because we can pick those winners and let the market do what it wants to do. All right, everybody. Freebies, hopefully you'll be a fully paid up member next week. Fully paid up members, thanks very much. Everybody, we will talk to you next week. Now go make a ton of money. Talk to you later. Bye-bye.